Chapter 19, Cost Management Systems. We have activity-based, just-in-time, and quality management systems. So for the first learning objective, we're going to assign direct cost and allocate indirect cost using predetermined overhead allocation rates with single and multiple allocation bases. Use activity-based costing, also known as ABC costing, to compute predetermined overhead allocation rates and allocate indirect cost. Use activity-based management, which is ABM, to make decisions, and use activity-based management in a service company. We're going to describe just-in-time JIT management systems and record transactions. Describe quality management systems, also known as QMS, and use the 4 types of quality cost to make decisions. So for learning objective 1, assigning direct cost and allocating our indirect cost using a predetermined overhead allocation rate with single and multiple allocation bases. So how do companies assign and allocate cost? We have product cost consists of direct materials, direct labor, and manufacturing overhead. They are easily traced and assigned to the product, and anything that's easily traceable is normally a direct material, direct labor. It's a direct cost. I think we may have mentioned that in our previous class as well, but direct cost, easily traceable. It's easy to identify that that cost is related to that product or service. And then allocated to the product, you have manufacturing overhead costs. Those are normally allocated, manufacturing overhead allocation. A single plant-wide rate is called the predetermined overhead allocation rate and is calculated before the period begins. It's a traditional approach of allocating your manufacturing overhead. It's also the simplest method to use, and one allocation base is used and applied to all units. Our predetermined overhead allocation rate formula and example. So to calculate your predetermined overhead allocation rate, you're going to take the total estimated overhead cost divided by the total estimated quantity of the overhead allocation base. So total cost divided by total quantity. In this example, we have our total estimated overhead cost of $100,000 and our total estimated direct labor cost was $250,000. So we're going to take that $100,000 divided by $250,000, and that's going to give us 40% of our direct labor cost. The manufacturing overhead cost can now be allocated to each model by multiplying this rate by the actual direct labor cost incurred. So you would take the 40,000 and multiply that by the actual cost incurred to get the percent that is related to your direct labor. Multiple department rates. So what if there are 2 departments with different allocation bases? For example, the overhead allocation base for the production department is machine hours, and the overhead allocation base for the software department is direct labor cost. So one department is using machine hours, the other department is using direct labor cost. What do you do? The total estimated overhead costs for the production company, the production department, are $80,000, and their total machine hours are 20,000. So to find the predetermined overhead allocation rate, they're going to take their total estimated overhead cost of $80,000 divided by the total estimated quantity of the overhead allocation base. And in this example, the allocation base is machine hours, so we're going to use 20,000. So you just replace whatever you're dividing it by. In this case, we're looking at machine hours, so that's why we're using machine hours. So 80,000 divided by 20,000 gives us $4 per machine hour. The estimated overhead costs for the software department are $20,000, and our direct labor costs are $31,250. To determine their predetermined overhead allocation rate, which is going to be direct labor costs, we're going to take the 20,000 in the software divided by the 31,250 estimated direct labor cost, and that's going to give us 64% of direct labor cost. So this is our predetermined overhead allocation rate, 64%. So looking here, we've got our total cost. We're looking at our standard model and our premium model. And we have, let's see, this is on page 995. So you've got your standard model and your premium model. In our standard model for our manufacturing overhead production, we've got 60,000. We're going to add the production and the software manufacturing overhead to give us our total manufacturing overhead. So you're going to add those to get your total manufacturing overhead. And then to find the manufacturing overhead cost per unit, to find the cost per unit, you take the total manufacturing overhead divided by the number of units, gives you your manufacturing overhead cost per unit. So that's another formula too. To find your total cost per unit, you're going to take your direct materials cost per unit plus your direct labor cost per unit plus your manufacturing overhead cost per unit, and that's going to give you your total cost per unit. So your manufacturing overhead production plus your manufacturing overhead software equals total manufacturing overhead. Total manufacturing overhead divided by the number of units equals manufacturing overhead cost per unit. Your total cost per unit is direct materials cost per unit plus direct labor cost per unit plus manufacturing overhead cost per unit. So all of your cost per units added together gives you your total cost per unit. And it's the same for the premium model. You calculate both the same way, standard or premium. And then analysis. So we've computed the standard model and we've computed the premium model, and now that we have done so, we can analyze both the standard model and the premium model. So we see here that under the standard model, our single plant-wide allocation rate was 273. The premium model was 407. For our multiple department allocation rates, our standard model cost is 275 and our premium model cost is 399. The difference between the two for our standard model is $1.84 negative, and for our premium model, the difference is $7.36. Use activity-based costing, ABC, to compute predetermined overhead allocation rates and allocate our indirect cost. Activity-based management, ABM, focuses on the primary activities the business performs. It uses cost information to make decisions that lead to greater profits. Activity-based costing, ABC, is the process of determining the cost of the activities as building blocks for allocating indirect cost to products and services. So here we're looking at examples of activities and allocation bases. For activities, we have quality inspection, warranty services, shipping, setup, machining, and purchasing. For quality inspection, they're inspecting raw materials or finished products, and the allocation base that we would use would be the number of inspections. When looking at warranties, they're providing service for defective products, products that are not working or working incorrectly. So the allocation base for our warranty services would be the number of service calls that we're responding to. Our shipping finished products to customers is the number of pounds of product shipped. How heavy? How much does it weigh? Setting up machines for production would be the number of batches. For machine usage, our allocation base would be machine hours. And for purchasing raw materials, our allocation base would be purchase orders. How many purchase orders do we have? So how is an activity-based costing system developed? First, we're going to identify the activities and estimate their total cost. We want to identify the allocation base for each activity and estimate the total quantity of each allocation base. We want to compute the predetermined overhead allocation rate for each activity and allocate indirect cost to the cost object. So with step one, identifying activities and estimating their total cost, we identify activities used to allocate manufacturing overhead. Examples of those activities include quality inspections, which are inspecting raw materials or finished products, shipping, so shipping finished products to customers, setting up machines for production, and purchasing raw materials. So identifying activities and estimating their total cost. So looking here, we have panel A and panel B. Panel A is a traditional system. Panel B is an ABC system, activity-based costing. So for the traditional system, we have we start with manufacturing overhead for both systems. With traditional, we have an allocation base in this example. So our allocation base is direct labor cost. And then from there, for our products, we've got either a standard model or a premium model. Under the ABC system, we do start with manufacturing overhead, and then we have our activities, activity-based costing. So our activity, we have setup activity, production activity, testing activity. And when we're doing the setup, their allocation base they're going to use is the number of batches. For production, they're going to use their direct labor hours. Production, producing the product, the allocation base is going to be direct hours, direct labor hours. For testing, the allocation base is going to be the number of tests performed. How many tests did they do? So, and then we move on down to our products. So for setup, we have just the standard model and the premium model. That's going to come from your number of batches. For production, you've got from your direct labor hours, standard model, premium model. And for testing, the number of tests, you have both standard and premium model. So the allocation base is really what changes, and that's just based on what the activity is. Smart Touch Learning determines that setup, production, and testing are the ABC allocation bases. So we've got our bases identified. So looking at this diagram, we've got setup, production, testing. The base we have identified for setup is going to be the number of batches. In the standard model, we had 40 batches. In the premium model, we had 20 batches. So the total number of batches that we have for setup is 60. 40 plus 20 is 60. And we do the same thing for production and testing. For production, we're using direct labor hours. We had 10,000 direct labor hours for standard, 2,500 for premium. So our total is 12,500 direct labor hours. For testing, we're using the number of tests. Our standard model had 7,750 tests. Our premium model had 2,250 tests. So we have a total of 10,000 tests for our testing allocation base. So now that we have our allocation bases, we can now plug those in. So to determine the predetermined overhead allocation rate, for setup, we took the 15,000 total estimated overhead cost divided by 60 batches. That was the total of standard and premium. And that gave us $250 per batch. Production, we took 65,000 total estimated overhead cost. We divided that by the 12,500, and that gave us $5.20 per direct labor hour. And then for testing, we took our 20,000 total estimated overhead cost divided by 10,000 test, which gave us $2 per test. And that is on page 997 if you wanted to look and see the estimated overhead cost. So here we're going to allocate our indirect cost to the cost object. So we've already gone through and we just did this top calculation here where we calculated the manufacturing overhead cost. To get the total manufacturing overhead, we're going to add that together. So we've got 77,000. Divide that by the number of units, which is 2,000 units. Gives us our manufacturing overhead cost per unit of $38.75. So total manufacturing overhead divided by the number of units equals manufacturing overhead cost per unit. And that's looking at our standard. We also have our premium down here. They're calculated the same way. looking at the traditional costing systems compared with the ABC system, we have our standard model and our premium model. We've got a single plant-wide allocation rate. And for the single plant-wide allocation rate, we're going to take our direct materials cost per unit plus our direct labor cost per unit plus our manufacturing overhead cost per unit, and that's going to give us our total cost per unit. And that's how we're also going to find the multiple department allocation rate and the activity-based allocation rate. So you're going to add all of these together to get this. And it's the same for each of these. Direct materials cost per unit plus direct labor cost per unit plus manufacturing overhead cost per unit equals total cost per unit. Use activity-based management to make decisions. So how can companies use activity-based management to make decisions? Activity-based management, ABM, uses activity-based cost to make decisions that increase profits while meeting customer needs. ABM decisions include pricing and a product mix and cost management. Pricing decision. If the cost per unit changes, should the selling price also change? What do you think? If the cost per unit changes, should we also change the selling price?
I think so. Like if it's supposed to cost more than anything, you probably should try to sell it to them.
It's up to you. What do you think? If the cost per unit changes, should the selling price also change?
Oh, yes. I think so. But I can still have like a, I don't know, like the right way to, they'll still be making money even though the price to make the product and it. I don't even know like the right way to use it.
Really, it just depends. This is one of the management, this is one of those decisions that managers have to make. You know, the price could go up or down. It doesn't mean you have to change the selling price, but you can. And you can change the selling price even if the cost stays the same. It's just really up to your discretion what you think. So you'd normally think, well, if the price to make this, if the cost is $5 and I'm selling it for 10, and now it costs me $4, should I sell it for 9? You may not do that. You might just leave it at 10 because that's what customers are used to paying, right? And then, hey, good for you. Now you're making an extra $1. Let's say the cost went from $5 to $6. Should you leave it at 10? Maybe that's what the customers are used to paying. You're still making a profit. You're just making a little less. Or you may bump your price up to 11 because you want, you may need to make $5 off that product. So it's really just up to management. There's not really a good or bad or right or wrong answer to that one. It just depends on what's best for the company. So very good for both of you guys. Because yeah, like a lot of times, So like pricing a product, first it's, well, here's the cost, and I'd like to make this, so I'm going to price it at that. But then if you realize that the cost of the product, I actually recently experienced this. But you're selling a product, you think it costs $10 for your cost. And so you're like, all right, my cost is 10, I'll sell it for 15. And then you price it at 15 to sell, but then you don't realize that there's fees for this and there's fees for that. And so now after all your fees are included in everything, now you could potentially be like breaking even or even losing money. So let's say you priced it at 10 and there were some fees, and you realized that you're still making some money, but you're not making as much as you thought you would be. Do you need to go in and change that and sell it for a little bit more? You can. Or sell it for less. So it's just really up to your discretion. Product mix decision. Comparing the gross profit of two products and sell the product with the greatest gross profit to maximize total gross profit, considering limited production capabilities. So you're comparing the gross profit of two products and selling the product with the greatest gross profit so that you can maximize your total gross profit. Do y'all understand that? I know it's a lot of words. Okay. Okay. No, I don't mind. So companies adopt ABC, activity-based costing, to get more accurate product cost for pricing and product mix decisions. Value engineering re-evaluates activities to reduce costs while satisfying customer needs. Cross-functional teams work together, including marketers, engineers, production personnel, and accountants. Anybody know what target pricing is?
I guess the definition says it's like I've heard a different word for it before.
You've probably heard it before. I mean, I'm sure you have.
Like an economics.
Economics or marketing or any of those business-related classes. So target pricing is the amount that customers are willing to pay for a product or service. So kind of going back to that, what we talked about a second ago, where you might have a product that you're selling at $10 and it originally costed you $5. Now it's costing you $4. Do you bump that price down or just leave it at 10? Customers have been paying $10 for it, so I mean, do you just leave it there because customers are willing to pay that? Target cost is the maximum amount of cost for you to develop, produce, and deliver the product or service and earn the desired profit that you want to earn. Cost-based pricing is the full product cost. It's the cost to develop, produce, and deliver the product or service. Desired profit is added to this full product cost to determine the sales price. So with target pricing, you kind of, you kind of look at price first, like what you want to make first, what you want your revenue to be. You still factor in costs and everything because you could potentially, you still factor in costs for all of them, but you're kind of more like, well, I really need to make $10 off this product for target pricing. Like that's what I want to make off of this product. Where cost-based pricing is looking more at the cost and then adding in what whatever they feel they need to do to get to the profit that they want. So we're going to look at some comparisons here. So for cost-based pricing, we have the full product cost plus whatever our desired profit is. So we desire this amount of profit, plus we're going to add in how much it costs us to make the product, and that equals the sales price of the product. For target pricing, you have your target sales price, what we want the sales price to be, minus our desired profit gives us our target cost. Activity-based management in a service company. So we're going to use the same steps to develop overhead rates that are used for manufacturing companies. Step 1, identify activities and estimate their total cost. Step 2, identify the allocation base for each activity and estimate the total quantity of each allocation base. Step 3, we're computing the predetermined overhead allocation rate for each activity. And in step 4, we're allocating indirect cost to the cost objects. In learning objective 5, so we're describing a just-in-time JIT management system and recording its transactions. So can anybody give me an example of just-in-time? Maybe like a company that uses it or does it, or a type of business?
Amazon. Amazon does, or, you just go, what is it called? Ross. You go to Ross and let's say something you might get from Walmart is like full price, like a t-shirt for $15, which is probably extreme for that particular shirt, because like, why is it $15? Is it the art on the shirt, or is it the fabric? But you go to Ross and you find that same t-shirt for $5.
Okay, so just-in-time management system reduces your inventory cost. So instead of having a lot of items in your warehouse or your, stored in the back of your business or wherever, just-in-time reduces the amount of inventory that you have on site. So raw materials and finished goods are completed just in time for delivery to customers. The cost of buying, storing, and moving inventory can be significant for companies. One of the main things that comes to mind when I think of this is like clothing, e-commerce, clothing brands that don't create the products on site, but they have like a third party that creates the items for them. And when a customer orders something, instead of it being automatically shipped immediately because it's housed in a factory, a warehouse somewhere, it is when the item is ordered, it's made by this company that's actually putting the print on the shirt and then shipped out. So the good thing about that is no inventory or reduced inventory. The bad thing about it is sometimes the cost can be a little more expensive. So you don't have the cost of storage space to hold the inventory until it's sold. For some businesses this works better than others. But just in time, it's something where raw materials and finished goods are completed just in time for delivery. They're not held on site, or there's not a lot held on site if you do happen to hold it on site. So how does just-in-time management systems, how do they work? So all just-in-time workers perform materials handling, assembly, and quality control functions. So a lot more eyes and hands are on this product. Up here, it could potentially just be one or two. Down here, you've got a lot more. They can be more specialized in what they do because this person can only do one thing, which makes them really good at it, because the more you do things, the better you get normally. Whereas up here, this person could kind of have a learning curve on each because they're having to swap back and forth between this and that all day. So just-in-time costing is a costing system that simplifies accounting for companies. It tracks cost after the units are completed, combines raw materials inventory and work-in-process inventory into raw and in-process inventory. And the conversion cost account combines direct labor and manufacturing overhead cost. When we're comparing traditional and just-in-time costing, for traditional costing, we have, for the production activity, it records the cost of products as they move through the manufacturing process. Inventory accounts for traditional are raw materials inventory, work-in-process inventory, and finished goods inventory. The manufacturing cost for traditional are direct materials and direct labor manufacturing overhead. For just-in-time, the production activity for just-in-time records the cost of products when units are completed. Cost is recorded when units are completed. And inventory accounts used are raw and in-process inventory and your finished goods inventory account. For just-in-time, your manufacturing costs are direct materials and conversion costs. So here we have Smart Touch Learning has purchased $305,000 of raw materials on account. So we haven't paid cash for it yet. So we've got our raw and in-process inventory. We're going to debit that account for $305,000, and we're going to credit our accounts payable account for $305,000. We incurred $255,000 for labor and overhead. So we're going to debit our conversion cost for $255,000, and we're going to credit our wages payable, accumulated depreciation for $255,000. Smart Touch Learning completed 2,000 standard model tablets that moved to finished goods inventory. So we've completed 2,000 and we've moved them to our finished goods inventory account. The standard cost for each tablet is $276.75. So we have $150 in direct materials plus $126.75 in our conversion cost. So for our finished goods inventory, we're going to have a debit of $553,500. For our raw and in-process inventory, we're going to have a credit of $300,000. And for our conversion cost, we're going to have a credit of $253,500. Smart Touch Learning sold 1,900 tablets on account for $500 each for a total of $950,000. The cost of goods sold is $525,825. So they have 1,900 tablets times $276.75. We sold the 1,900 tablets on account, so we're going to have an accounts receivable. So we're going to debit our accounts receivable account for $950,000. We're going to credit our sales revenue account for $950,000. For our cost of goods sold, to record the cost, We're going to debit our cost of goods sold account for $525, and we're going to credit our finished goods inventory for the same. So here we have recording transactions in just-in-time costing accounts. So we've got our raw and in-process inventory account, which is located in our balance sheet. Finished goods inventory is in our balance sheet, and conversion cost. So when we look at our raw and in-process inventory account, we started out with $20,000 in there. And then transaction 1 happened. We debited the account $305,000. Then transaction 3 happened. We credited the account $300,000. And to get the new balance of the account, we take the $20,000, the $305,000, the $300,000, and that's going to leave us with a debit of $25,000. And you can kind of look through these. Finished goods, conversion costs. And then once the item is complete and sold, it moves to our income statement and our cost of goods sold account. So that here we're looking at an adjustment. We have the actual conversion cost incurred of $255,000, and the amount of conversion cost that was allocated was $253,500. So at the beginning of the period, we allocated $253,500. And then at the end of the period, we realized that our actuals was $255,000. So we have a difference of $1,500. So now we're adjusting for and fixing, truing up this account. So we're going to debit our cost of goods sold for $1,500, and we're going to credit our conversion cost for $1,500 to record that adjustment and fix this allocation. The adjustment for conversion costs. So here we actually see it going through our conversion cost account and our cost of goods sold account. So we credited conversion cost for $1,500 and debited cost of goods sold for $1,500 to true that up. Learning Objective 6, describe quality management systems, QMS, and use the 4 types of quality cost to make decisions. How do companies manage quality using a quality management system? A system that helps managers improve the business's performance by providing quality products and services is called a quality management system. The goals of quality management systems are to improve performance, increase customer satisfaction, and increase profits. Four types of quality cost are prevention cost, appraisal cost, internal failure cost, and external failure cost. So can you give me an idea of a prevention cost? What would be a good prevention cost? Maybe like a fridge to keep your food cold. Maybe you're a service, a fast food restaurant or something. What about appraisal cost? So prevention cost is cost incurred to avoid poor quality goods or services. What about an appraisal cost? An appraisal cost is a cost incurred to detect poor quality materials, goods, or services. So it would be an example of an appraisal cost, besides a house appraisal. To detect poor quality materials, goods, or services. Maybe like an inspection. Somebody comes through and inspects what you did. Internal failure cost. Cost incurred to correct goods or services before delivery to customers. So these are internal costs that happen before the products are delivered to customers. So maybe like testing the product. Maybe, we have our employees. We went through like a few examples back on the slides. We had testing as one of the locations for the product. So we put the product together, and then it went through testing to test it, make sure that it's working properly, or if it's closed, the sizes are correct, or the colors are right, or the tablets they're cutting on. So internal failure costs are costs that are incurred to correct goods or services before they go out to the customer. External failure costs, these are costs that are incurred after delivery to the customer has occurred. So external failure costs, maybe the customer bought the product, it didn't work, so now you have a return, a refund. The customer could also potentially not buy from you again, or give you a bad review because you sent them a product that didn't work, or was wrong size, color, whatever. So those are 4 types of quality costs. And then here we just kind of break those down a little bit more. So prevention cost, training. So if we, I know a few people have gone into professions that maybe they didn't even have like any experience in, they've never done it before, and they get hired, they get in there, but they've never done it and they don't really know how to do it, and things can go bad, right? You don't really know what you're doing. Well, one way to prevent that from happening, or reduce the risk of things going bad or stuff not being done right or whatever, is training. So making sure that your employees are trained on how to do their job. Evaluation of the quality of suppliers' processes. So who's supplying you the materials needed in order to create whatever it is you're creating or perform whatever job you're trying to perform. Preventative maintenance on equipment. If your equipment fails, you can't, a lot of times, sometimes it completely stops production. So making sure that your equipment is working properly and properly maintained so that you don't end up having to shut everything down for a few days or however long it takes to get it fixed. You just keep it working. That goes back to your vehicle. If you have a vehicle that you drive, I'm the worst. I can't stand taking my car to get it serviced. It takes too long. But then I wait, and I wait, and I wait, and I end up with a flat tire, and then I have no car for a while because now I have to have it towed to get a tire when I should have just taken it. This happened recently. So preventative maintenance on equipment, keeping it, good. Even though I just told you guys I don't always do that, but it's good if you can because it will save you in the long run. In my case, it could have been an hour changing a tire, but it turned into a few days, so it wasn't good. Appraisal cost. So inspection at various stages of production. So they're inspecting at different stages of production. They are also looking at the final products or services, and can also be testing the products as well to make sure that they're working properly. Internal failure costs are any production problem that causes manufacturing to stop. So anything that halts manufacturing is an internal failure cost. reworking substandard products. So you've got some that weren't up to par, and you're going to go back and you're going to try to fix them or tweak them or whatever to get them to work properly. And then you also have your rejected products, which are just, they're rejected. That didn't work. We're moving on. Drop it in that pile over there to get rid of. And then you have external failure costs. So you lost sales due to unhappy customers. You know, the product got all the way to the customer. We didn't find we didn't find the issues, the errors. We didn't check it to make sure it was working properly or was the right size. The customer got it and they were like, this is supposed to be a large and this is like an extra small. What in the world? This is not what I ordered. Like, or the color, or, you know, design, or maybe they bought a remote control car and they got it and it doesn't work. So I will say that if I order something and it's not what I wanted, I'm not the type of person to like say negative things. And I also do not like going to FedEx or wherever to return my stuff, but I will not order from you ever again. Like, it'll go into the, maybe go into the donation box, and I will never order from you again. So, you know, just making sure that your customers are happy, because, you know, some people, if you send them, and there are some that, you know, if you send them a bad product, you know, it could be a complete mistake. You know, somebody really did overlook it and they sent you this item, but now all of a sudden you're seeing like bad reviews or remarks or whatever. So, you know, I got this from this company and it was supposed to be this, but it was that. And so you just have to be very careful, especially now with social media and everything too, because like people will post anything. So now you're, you know, you may not have only lost that one customer. Now you could be losing all that customer's friends, or even more people than that, simply because of that one small thing. So making sure that your items are good and inspected and working properly are a big deal. You also have warranty costs. So if someone does have to return an item and have it fixed due to like a warranty issue or something like that, you're going to have the cost of warranty for fixing that product. Service cost at the customer sites, and sales returns that are due to product defects, where they return the product due to a defect. So here we're looking at Smart Touch Learning's proposed quality improvement plan. So to improve their quality, they're going to undertake the quality improvement program. They're going to look at prevention and appraisal. And so this is what they're planning to do, and this is what they expect it to cost. So their total prevention costs are this $850,000. And then for appraisal, this is what they expect this to be: to inspect raw materials, $100,000, inspect finished goods, $150,000. So they expect their total appraisal cost to be $250,000. The total cost of undertaking the quality improvement program, it would cost them $1,100,000 if they decide to take the quality improvement program. If they decide not to do the quality improvement program, then, and they end up having internal failure, the internal failure cost is going to be this amount. And if they happen to have external failure would be this amount. So the total cost for them not to take the quality improvement program would be $1,200,000. So what they're doing is they are comparing. They are saying, if we decide to use this quality improvement program and work towards preventing our items from being faulty and making our customers happy, it will cost us $1,100,000. if we say, you know what, things are doing just fine for us, we're not going to bother with paying for all this additional stuff up here. We're just going to keep doing what we're doing, and if we have the consequences, this is what our consequences are going to be. So our internal failure, we are expecting to cost us this. Our external failure, we expect to cost us this. So if we don't do anything to fix our quality and we remain the same, then our cost would be $1,200,000. So what should we do? Should we take the quality plan, or should we leave things the way that they are? Teddy, should we take the quality plan, or should we leave things the way they are? What do you think?
I think you should keep it the way it is. Because it's only increased $100,000, right?
In cost. So what do you think?
I think you should probably leave it because, like he was saying, it's like if you end up not eating it, then you save yourself over $1 million, and then if you end up eating it, it's only an extra 100.
So in the real world, you could think about all of that. So in this example, what we would do, like if this was a problem that you were answering, you're going to go with whatever costs the least. In the real world, these are budgeted, could be types of things. So it's not a huge, because $100,000 for some people is a lot of money. So, but it's like, it's not a huge difference. This could be less than what we even anticipated, so we'll just stick with what we're doing. I get that. But for this, if this was a question and you had to pick between the cost of undertaking quality improvement or the cost of not undertaking quality improvement, you would, because we're talking about cost, you want your cost to be low, so you would go with this one, so that you'd make that extra $100,000. So you'd go with undertaking the quality improvement program.